All I've done for the last few years is work 16 hours a day, 7 days a week in the real estate industry, and something has become apparently clear. We may have a real issue on our hands. We may have actually broken the housing market. Last week, the Fed's monetary tightening policy has pushed mortgage rates to an all-time high since 2001, and they could keep going higher towards the end of the year. Mohammed Al-Arian, who is the chief economic advisor at Allianz, just recently said the Fed may have crushed demand and supply because rates are at an all-time high of 7.23% as of August 23rd, 2023, which was last week. He said when you go from record low mortgage rates to the highest we've seen in 20 years, you're gonna destroy supply and demand. Hey guys, it's Andy Coleman. As a realtor working with buyers, sellers, and renters every single day, I am seeing this in real time unfold right before our eyes. The federal funds rate was raised to the 5.5% last July. The Fed could raise it even higher, which would increase the mortgage rates even more if they do that. This is a big factor why the mortgage rates are right now at 7.23% because the federal funds rate is also very high right now. So there's a direct correlation between the two. For those that don't know, the federal funds rate is the main monetary policy tool for the Federal Reserve. In layman's terms, it's the interest rate that banks charge one another for short-term loans. Now listen, there's no such thing as a federal mortgage rate. The federal funds rate influences interest rates for longer-term loans like mortgages. Chief economist Al-Arian warned that we've got to be really careful that the central housing market is crucial to the economy. Working as a real estate agent every single day, I have to agree with his assessment. These high interest rates are currently putting buyers and sellers at a standstill. That is why I have been so adamant over these past few years that it's not a buyer's market and it's not a seller's market, it's a renter's market. High interest rates have brought down housing supply and demand, with many buyers being priced out because sellers don't want to let go of their really low interest rate and buyers can't afford to buy houses with these really high interest rates. If that wasn't bad enough, the median home sale price actually rose 1.7% year over year. It's currently sitting right around $421,000 according to Redfin. This is just 2.5% lower than the record high that was set back in May, which was $432,000 last year during the pandemic at the peak. According to the Mortgage Banker Associations, applications for home loans have fallen to the lowest level since 1995. Everybody's favorite Fed chair, Jerome Powell, had just recently said that he wants to get inflation rates down to 2%, but he doesn't see that happening until 2025 at the earliest. What we're looking at right now is that headline inflation actually might start going back up again. According to Freddie Mac, it's still sitting at about 7.18% because inflation keeps lingering. I want to get into why this actually matters, and I want to talk about where rates were over the last few years. So a year ago in 2022, the 30-year fixed mortgage rate was 5.66%. The average rate in 2021 was 2.96%, which was actually the lowest rate in 30 years. Now in 2020, the average rate was 3.1%. And then a year before COVID, the average interest rate was 3.94% in 2019. So as you can see, since the pandemic hit, the interest rates were actually going lower until last year when they started to rise even higher so the Fed could impact the housing market and try to get home prices down a little bit lower. It did work a little bit. Like I said before, we're down about 2.5%, but it's just not enough yet. So then what does this all mean for the housing market moving forward? Well, the historic drop in interest rates could mean that homeowners that bought houses a couple years ago and got locked in at these crazy low interest rates, they don't want to sell their houses anymore because if they do, it's going to hurt their bottom line. If they sell their house right now, they're going to lose their cushy interest rate and they could potentially lose tens of thousands of dollars over the long run. So why would they want to sell or refinance their homes if they're going to get stuck with today's much higher interest rates? That is why the market is at a standstill right now, because sellers do not want to sell their house. They're going to take too big of a hit. They're going to lose their low interest rate. So they're not going to sell their houses right now. And on the flip side, buyers don't want to buy right now because the price of houses are still way too high and the interest rates are also too high. So it's creating a situation where buyers can't buy because they can't afford it. Home prices are almost at an historic high right now. Like I said before, about 2.5% down from the previous high in May of 2022. This is due to the Fed's historic inflation curbing campaign that sent home affordability to its lowest levels in nearly 40 years. The added cost of financing a home right now because of the mortgage rates and in combination with the very low supply of houses right now is causing houses to be at the highest price they've been in many years. worse. That's why the housing market is in such trouble right now, because house prices haven't fallen enough for it to make sense for buyers to start wanting to buy again. It's simple supply and demand. If the supply is really low, like we have right now, but demand is really high, then that's going to cause the prices to go up, which is exactly what we're seeing now and have been seeing for the past couple years. Like I said before, homeowners that locked in such a low interest rate, they're reluctant to sell right now because they're going to get stuck with today's higher interest rates. So they're just sitting on their houses, which is causing lower supply. The combination of low inventory and high cost has squeezed out many of the people that would want to buy a house, but they can't afford it now. So instead of buying, they're going to turn to renting instead. This has resulted in the number of homes being sold to go down even lower than it was last year. The housing market is facing a very tricky situation now. The likes of which we haven't seen in a very long time. In my opinion, something has to give. This cannot sustain this path for that much longer. I personally think we're going to be facing another 2008 crisis, which leads me into my next point. Where are rates going to go from here? Sam Qatar, who is Freddie Mac's chief economist, said this: recent volatility makes it difficult to forecast where rates are going to go next, but we should have a better gauge in September as the Federal Reserve determines their next steps in regards to interest rates going higher or lower. From everything I'm seeing, it looks like they're going to hike the rates even more come September. Now, the economy does remain strong as inflation is well above the 2% that the Federal Reserve is aiming for, which has kept interest rates relatively high. The bond market is concerned that by taming the interest rates, the Federal Reserve may have to raise rates even higher. The central bank has 3 remaining meetings left this year to determine where rates are going to go and if they're going to raise them even higher. And in my opinion, I think they're going to go up. Later in the video, I'm going to break down exactly why I think that. Fed Chair Jerome Powell has emphasized the importance of July's core personal consumption expenditure, which is the price index for the Fed's future path. But the highly anticipated PCE index has remained that inflation was high at 3.3% back in July. Now, yes, while inflation is still high, the 0.2% increase in inflation is still right where the Fed wants the inflation rate to be. However, this means that borrowers can expect to see costs remain really high over the next term. As I said before, the Fed does not directly set these interest rates, but it goes hand in hand with the Federal Reserve policy. So its actions do affect what borrowers pay on mortgage rates. You see, mortgage rates tend to track the 10-year yield on U.S. Treasuries, which move based on the anticipation of the Fed's actions. So it's what the Fed actually does, and then investors react to it. When Treasury yields go up, so do mortgage rates. When they go down, mortgage rates tend to follow. Here's the thing, there may be other signs that tend to show that the economy is actually slowing. U.S. job openings actually dropped in July, providing new evidence that the labor market is cooling, which is also directly impacting the housing market and why it's been the worst market in nearly 40 years. Now, yes, the summer selling season does typically wind down in August, but it's been especially quiet because the affordability of homes are so high right now. So the combination of a 20-year high mortgage rate and the very low inventory is creating a bad situation for home buyers across the country. That's not all to say it's all bad news right now. As rates started slowly coming down last week, home buyers actually started to come back out. Applications for mortgages rose from their 28-year low, according to the Mortgage Bankers Association. The last full week of August ended on a positive note, with mortgage rates for home purchases actually increasing for the first time in almost 5 weeks. We don't know if mortgage rates are going to be lower over the coming months, but if it does, it's going to help affordability and have some buyers come out of the woodworks to start buying houses again. Now, I'm not sure if this is going to happen. It really depends on what the Fed does, so we're really just going to have to wait and see. So I want to give a little bit of context on what the U.S. housing market is doing now compared to the last 50 years. Today's mortgage rates are still a lot lower than they were in 1981, when they were sitting at 16.6%. So do the math. When they're at around 7.25% right now compared to 16%, they're still less than half of what they were back 50 years ago. These incredibly high interest rates in the late 1970s and early 1980s were directly caused by extremely high inflation. Inflation erodes the purchasing power, and high interest rates can counteract that, which would then cause interest rates to go up. Back then, the Federal Reserve, led by Chairman Paul Volcker, used this tactic to curb inflation by raising the interest rates to that 16.6% rate. So we're nowhere near as bad as it was 50 years ago. So just keep that in the back of your mind. It could always get much worse. Back then, Volcker believed that to tame inflation, they had to restrict the supply of money, even if this led to a short-term slowdown in the economy. As a result, the Federal Reserve raised the federal funds rate to historically high levels. And as you can see, that's why the federal funds rate and mortgage rates goes hand in hand. Also, back in 1970, the US economy was categorized as stagflation, which I'm sure you've heard of before. That's a combination of static growth and inflation. This posed a really big dilemma. The tools to combat inflation could result in raising stagnation and vice versa. Just a little history lesson. Back in the 1970s, we saw two oil crises which did cause higher inflation. And as you all know, when the price of oil goes up, it costs more for goods and services, which is again gonna cause inflation. And all of this led to the public perception thinking that inflation was getting even worse than it actually was, which caused it to go up even higher. As people began to expect higher inflation in the future, they demanded that wages also be increased, which led to higher interest rates, leading to a feedback loop which made inflation more persistent. These extremely high interest rates back in 1981 caused a massive recession. However, these tough policies broke the back of inflation, which got us out of the hole. So ultimately, in the end, it did actually work, and the Fed accomplished what they sought out to do, which was curb inflation. If history is any indication of the future, I think this cycle is repeating itself right now in real time. So I just want to warn everybody, if you're looking to buy or sell a house in the next couple years, be very cautious on what you do next. Now, nobody has a crystal ball. I don't know if we're going to go into a crazy recession like we did back 50 years ago or even back in 2008, but all indicators are looking like, yes, we are going to have a bad recession again. The housing market as it currently stands is unsustainable. There is no way that these prices of these homes can remain this high for that long while interest rates also remain this high. Something has to give. My advice is just be patient and wait to see what the Fed does next, because they are going to directly impact what the housing market and economy does moving forward. Well, that's all I got for you guys. I hope you guys liked the video. If you did, smash a like button, drop a comment below where you think the housing market is going to go over the next couple years. Don't forget to subscribe, and I'll catch everybody in the next one. All right, that was pretty good.